Oops, this should have a multiple. This should have stuff in there too. Hold on. Who the heck made this thing anyway? All right, so yeah, so that's what this will look like. Sorry about that. Yeah, so make sure you change that to 1700 if you haven't already. Again, the cost of goods sold is the hard part to get here. This is the tricky one. The sales are easy. You know, sales or whatever they are. Costs are always hard. And so this is the ending inventory. This is what was not sold. We still have it. So there's, well, a total of 130 units we have available. But yeah, so the two layers. Now starting the next period, we'll wait to the end of the period. And by the way I'm showing you, this is called periodic inventory. It's when you take it at the end of a period. For instance, a month, a year, whatever it is. They call it periodic inventory. There is perpetual inventory, which means after every sale you update it. And usually those are done on computerized systems, obviously. But for instance, in the grocery store, you know, a grocery store, they'll show an inventory of 365 gallons of milk. You take a gallon of milk up there, they ring it up. In the system, it'll say, okay, we don't have 365 anymore. Now we have 364. And, you know, everyone, and so it'll update it immediately. And they do that for especially things like grocery stores and that. So they know when to order stuff. So they, okay, we get down to 100 gallons of milk, we got to order because it takes 2 days to get the milk in and whatever. So so that's a perpetual, what they call a perpetual system. This is periodic. And this is, you know, at the end of every period, you would calculate the inventory. So in this case, it's for the month of January. Some question on that thing?
Can you repeat what perpetual inventory is again? Sorry.
Yes, no. It's I can't. It's not. Yeah, let's see if I can. Let me take this and make an example out of it. I got to do something a little different with it though. It'd be after each sale, so you'd have to know when the sales were made. So let me clean this up. Oops. You'd have to know the dates of the inventory and when you made the sale. We started like this. We'd have to do say, okay, let's say January sales look like this. We made a sale on, oops. Can I do that? Yeah, I can do that. Okay. Ah. you have to know the days of the sale. So for instance, you made the sale on 1/5, you would immediately take the last ones in, which would be from the first, and calculate the cost of goods sold from that. So this would be the cost of goods sold from, oops, what am I doing here, man? Come on. So the cost of goods sold would come from that first layer. We'd only take 100 of them. We get 5. So this would be the cost of goods sold for that one. For that sale. So you do it for every single sale, you'd have to take it separately. LIFO is a little bit difficult because the last ones in will change, or they can change, I should say. So for instance, this next one will look like this. Cost of goods sold would come from the 9th. Sold 100 of them at $6 each. Or excuse me, the cost of goods sold is $6 each. So after every single sale, you calculate the cost of goods sold. And again, you know, if you're doing it by hand, this is a really cumbersome thing to do. In a computerized system, it's not so bad. You can automatically do that. But yeah, so this would be after each sale, it would calculate the cost of goods sold. And it would update your inventory. It would say, okay, you know, our inventory, you know, you'd keep a running total of the inventory, whatever was in there. So it'd be minus 100 here, minus 100 here, and so on and so forth. So every single sale you would make a journal entry for the cost of goods sold. So this is perpetual. Oops. Well, but wait, we are not doing this in. It really is. It's the same as what we did before, except that it does it after every single sale. It doesn't wait for the period to end. So if you make a sale in January, on January 5th, figure out what's the last one's in, and that's your cost of goods sold. Same thing on the 12th. Well, the last one's in, the last one's in came in on the 9th. Go there first. These tend to be kind of cumbersome to do by hand, as you can imagine, because you can have a number, you know, you can have running totals for a number of layers. Sell this on this date, sold 5 on this date, sold 20 on the, you know, you can have, each layer can have multiple sales out of it. And again, it's the same thing as we did before, except that instead of for the whole period, we take it for each sale. So I broke it up for 3 sales of 100, whatever these are. Notice on this one, they're all lumped together. You know, it doesn't say when these sales were made. And for periodic, you don't really need to know when the sales were made. Right, so you just need to know the total for the period. Whereas if you're doing perpetual, you need to know each individual sale, when it was made, find the last ones in for that date. Again, computerized system, not a problem. Doing it by hand, it's doable. It's just, you know, it's just really tedious. Again, this will not be on the test. Maybe I'll put a multiple choice question that, just this says what is it or something like that. But not a, there's not gonna be a problem like this. By the way, I don't know if I told you, there's actually dozens of ways to keep track of inventory. I know it sounds strange, but and they're all accepted. I might as well talk about it now. We talk about inventory, we're talking about kind of like depreciation. It's the allocation of cost. And there really are, I think I talked about this before, there really only are two criteria for it. Oops, it's not a one. It must be systematic. Rational. So anytime you run into an allocation problem, the true guidance that they give for the accounting rules are that it must be systematic and it must be rational. So we're going over LIFO, FIFO, average cost, but there's other ones too. And if you can come up with ones that on your own that are systematic and rational, they're okay. Systematic means it's repeatable with the same results. So if I do LIFO and I do LIFO, you do LIFO, we should get the same numbers. Oops. And rational just means that it makes sense. I'll tell you that LIFO, the Europeans and the international standards, they don't think this of the LIFO method. They don't think it's rational and makes sense because the actual flow is not going to be LIFO. In the United States, we say, oh, it makes sense because that's the more accurate number. The last ones in are the more accurate. It will give us a more accurate income. But the international standards.
You said that, sorry, you said that in like the UK and in Asia, they use the other one?
You cannot use LIFO, correct? Yeah, the standards, international standards used in mostly in Europe and in the Asian countries, you cannot use LIFO. It's prohibited. Only the United States uses LIFO. And the numbers of companies using LIFO is going down. It used to be really kind of highly pushed because it was like people saying, look, this is more accurate. This is more accurate income. But because I think it's almost like too theoretical in that it's not the actual flow of goods and not the normal way you think about business. The first one's in would be the first one sold. That'd be the natural way to think about it. So I think for those reasons they don't allow it. But United States is the only country that uses it. Yeah, and it used to be almost required for the taxes, but they're kind of backing off on that too, that they use LIFO. So yeah, so the only two criteria are systematic and it's rational. There actually are dozens of ways to do inventory. Different. Sometimes they put it into pools. Sometimes they put it into. They group them in different ways. Cost, but as long as they're systematic and they're rational, it's okay. All right. So let's see here. So this is for the January sales. So this would be a period. So this would be a periodic. Yeah. And again, we don't know exactly what dates the sales are made on, and for the periodic method, we don't need to. Okay, any questions on any of these? The especially the cost of goods sold and the ending inventory. And again, these are the tricky ones. And you'll notice though too, and I think I mentioned this before, the beginning inventory, using the LIFO method, that beginning inventory may stick around for decades if you never sell it all the way down. You know, so you can get some really kind of funny things happening where you can have stuff on the books from 1986, which just intuitively know is not whatever you paid for in 1986 is not relevant today. So that's another problem with the LIFO method, is that you get these costs hanging around for years. Okay, let's go to, I don't think I did this one. Yeah, I don't think it, ADA is number 10 too, I think. I don't think I did number 10. Nope. Okay. Number 10, we got to find the total cost. So like this. Replace these ads with times. I might as well do the sales. $30,000. Okay, so these are the sales. Inventory. Okay, so this one we got to multiply these out to get the total cost. $80 times 30 is 2,400. No more zero. Okay. Oops, totals. So we have total units we have available is
400.
missed how you spell available. So 400 units, and this is what, 17,200? Let me check that just to make sure. So I'm doing it in my head is not the best thing. Yeah. Okay, so these are the total costs. And this is total available. So what we're going to do is divide them. I'm going to take the 17,200 divided by 400 units equals some number. $43. There he is yet. That's not a 4. That's a 3. Well, let's try that again. $43. So this will be our average cost. So it's called the weighted average cost. Let's see here. So our average cost per unit is $43. And by the way, there is kind of you can kind of reasonably check in here that, if it's an average cost, it has to be between 30 and 50, right? If you're gonna take an average, it has to be between those two. So again, if you come up with some number like 63 or whatever, you'll know that you did it wrong because it should be in the middle of there somewhere. And 43 is between those two, so. And it also is a little bit higher than the middle part here, 40, because you have more units at 200. Now, the nice thing is once you get that average cost per unit, cost of goods sold and any inventory are really easy. The total cost of goods sold would be 12,900. Okay, now, if we had 400 units available and we sold 300, how many were not sold?
100.
Yep. Oh, wait, I gotta do the, oh, hold on a second, I jumped ahead here. Sorry about this. So sales, cost of goods sold. Okay, I think that's it for that. Okay. So coming down here to calculate ending inventory. Little room out here. The available units was 400. Units sold was 300. So our ending inventory, in other words, not sold, 100. Just say units in. So the average cost, once you get the average cost per unit, it's actually way easier than the other ones. You know, because it's just one number. You know, how many units do you sell for the period? 300. Okay, what's the average cost of them? That. And wait a minute, I went too far. I want to show you something too, though. Here we got this total 400 at 1720. We'll go to the next page here, get some more room. You don't have to write this down. I just want to kind of show you something though. So the ones that were sold were 12,900. The ending were not sold. You'll notice that the totals, you know, the totals of those come out to the same as this. And by the way, this is true for all of these, for all the inventory ones. The cost of the goods sold and the ending inventory will always come out to this total amount available. We didn't have to calculate it for doing the last in, first out, or first in, first out, but it'll be the same. Now, you might be wondering, why am I telling you this? Who cares? Well, here's why I'm telling you this. If you get one of these, if you get the, say the cost of goods sold, you really don't have to go through the calculations for the ending to get the dollar amount, because you know they have to equal 17,200. So if you sold this, you just subtract it and get this number, because they're either sold or not. So if this amount that was sold out of the 17,200, if 12,900 was sold, you know that whatever it is has to be, you know, whatever it'll take to make it up to the 17,200. And by the way, this will work for all of them. Now, in the books, a lot of times it gets confusing because I'm going all the way back to the first one up here just because it's a shorter one. Let's not take it. Let's take this one. I'm looking at number 4. But anyway, let me making a mess out of this. The point being is, if you get the totals of them, you can simply compare this to what the totals were. Well, I mean, I'll show you guys this later. I'm not wasting too much time with it. But anyway, it'll work for all of these. Oh, I know. I show you number 9. Number 9, we already get the numbers. The total is 4360. If you add up the 216 plus the 1744, it should come out to that number. So, so at this point, you could, if you, once you get the cost of goods sold, you could actually just subtract to get the ending inventory. Okay, so this should come out. Now let's get a calculator here. So this total of 4360, that's the both the sold and the ending inventory. So if you get the cost of goods sold, you can theoretically just take the total cost of the inventory and subtract it out, and that'll give you the ending. And sometimes, yeah, I'll say this now, Sean. Sometimes the books will show something that looks kind of confusing because they'll say, okay, if you're doing, let's say, first in, first out. If you got a whole bunch of layers for the first in, first out, let's say that you have 20 layers of inventory, but the ending inventory may only have a couple. You say, okay, well, instead of doing these, 20 layers of inventory, the ending inventory, it might be easier just to take, if the first ones in were sold, then the last ones in must be in the ending inventory. Just take the last ones in for the ending inventory. It's confusing because, the terms last in, first out and all that kind of stuff. But taking the ending inventory sometimes is a quicker way of getting the cost of goods sold. Okay. Multi-step income statement. I don't think I have a good way to show this one. Maybe I do. I'll try. So multi-step income statement. It's similar to the classified balance sheet. And we remember the order of it by scoot. This is on page, I don't know if my pages are the same as yours. Is this on your page 12? Or is it on page 11?
11.
It's on 11. Okay.
11.
Okay, so page 11. Somewhere I got goofed up here. So remember the order by scoot. Or maybe scootee is a better word for it. And it's similar to our shorten this thing up. It's similar to our classified balance sheet. In that we put things that are similar together. So scoot, we have the S is for sales. So we have sales or revenue, same thing. We'll subtract out any returns we have and we'll end up with net sales. Returns or discounts or whatever they may be. Oops. C stands for cost of goods sold. The first O is for operating expenses. And those are mostly selling and administrative expenses. And we'll split between these two of the next. The second O, confusingly, is other revenues, expenses. Okay, now you may be wondering, okay, well, what's the difference here? Operating expenses are things that are necessary for the business. Other revenue expenses are what they call incidental to the business, for the business. So operating expenses are things that are necessary for the business. So things like selling expenses are necessary. You know, you have to have a store, you have to have salespeople, you have to have, you know, all the things that are going to running a store, store managers, store, you know, people that stock the store, all that kind of stuff. Those are all things that are necessary to run the business. Administrative expenses are things like, well, like accounting for one thing, but also upper management and things like that will all be administrative expenses. The things that you have to run the business. The things down here are things that you're really not in business for. For example, if you run a pizza parlor, you run a pizza restaurant, you make your money selling pizzas, right? Now, incidental to that, you may have a bank account. You probably will have a bank account, and you'll take your daily deposits and you'll deposit them in the bank, right? On that bank, on your bank account, you may earn interest. You know, it may not be a lot, but you earn some interest. Now, you're not in the business of earning interest. You're in the business of making pizza. So this is something that, while it does actually happen, you do earn interest on your bank account. It's not necessarily as for the business to run, you know, to have that. So these are kind of things that are, they actually happen. You know, it isn't like that, oh, these things are not real or whatever. They are, but they're just not what you're in business for. So the operating expenses are the things that are necessary. And by the way, this operating income, those of you that are going into finance or even in management, this is usually the number that a lot of analysts will focus on, even more than the net income. Because this operating income is, okay, for whatever it is they're doing to make money, how well are they doing? For General Motors, you know, okay, they make cars. How much are they actually making on the cars? I don't care what they're making on their bank accounts or anything like that. I want to know how much they're making on their cars. They're a core part of the business. So this operating income is actually a fairly important number for a lot of people that analyze companies. But anyway, these are things that are necessary for the business. And we put these things that are down here that are incidental. Gains on sales on assets, losses on sales of assets. These are things like you have a pizza delivery truck and it's getting old, so you buy a new pizza delivery truck and you sell the old one. Now, you're not in the business of selling trucks. You're making pizzas, but incidental to the business is that you got this new truck and you sold the old one. Again, you're not in the business of selling trucks. So while it did happen, you did sell the old truck, it's not really what you're in business for. So these are things that are incidental to the business. These are things that are, they actually happen, but they're not necessary for business. And the two that are, or the main one, a couple of the main ones here are the interest expense and interest income are both included in there. Okay, so and the separating these two is the kind of the big part of the of the multi-step income statement. These things are more important than these things usually. Down here, tax expense, or something's called income tax expense, is paying taxes on your income. And then finally, we'll end up with our net income at the very bottom, just like we have income for. Now, we should, let's look at that. Oh, there's our gross profit that we just talked about. Income before taxes down here. But anyway, so this is kind of putting things into categories that make it a little bit more easy for people that want to use this information to make decisions. So if you're in finance, this would be, you want this broken up this way. I am going to I'm going to hold off on this actually. We'll do this next class. I don't think, the reason I say that, I don't think we have time to finish it. So let's stop here. And we start class next Tuesday. We'll go over this. And I want to take a little bit of time on this multi-step income statement because you guys are going to see this in many of your other classes. Your finance classes, you might see it in the econ classes, there's other places you'll see this. So anyway, the multi-step income statement is one of those things that is good to know. It's good to know going forward. Okay, so we'll stop here and let me save it. Okay. Any questions? Look at that. Early. Look at that. All right. See, I keep you guys late every day and not today. Certainly. Any questions on the multi-step income statement? Again, we'll do that. We'll do it next class. I don't want to get halfway through it and then have, try to pick it up and all that kind of stuff. So anyway, we'll cover that next class. Any questions? Okay, well, have a good weekend and I'll talk to you guys on Tuesday.
Thank you. Same here.
Thank you.
Thank you.
Okay.
Professor, for our, sorry to ask so ahead in advance, but for our final, will you be, like, how will it be structured? Will it be on everything from the beginning of the course?
There is no final.
Oh, there isn't a final?
It's just, no, we just do chapter exams.
Oh, that's such a relief. I love when
Yeah,
classes
no,
do
and-
chapter exams.
And one of the reasons why we break it up into smaller chunks to,
One of my other classes does that. And I mean, each one is worth like 20% of the grade, but it's nicer to have it broken up.
Yeah, no, well, in different classes are different material, it might be appropriate and all that, but it's just, people generally learn more if you break it up into smaller chunks and do it this way, so that's why I do it.
Yeah, okay, well, I appreciate that. Thank you.
Yeah, no final.
Okay.